Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Anthony, how are you today?
Good. Looking forward to this podcast. Out of all the podcasts we've done, I think that this is the one that we've done the most prep for.
Ooh, I agree with that.
Right? Because there's a lot of good information here, and we're really looking forward to sharing it.
Absolutely. So today what we're going to be talking about is we're going to be comparing whole life insurance versus indexed or just universal life insurance in general. And the reason that we're doing this is because this is a question that I know I get several times a week, and I got to guess that you do too, Anthony.
Yeah, I got this twice yesterday, as a matter of fact.
Twice in one day. Well, awesome. So today what we're going to do is we're going to give you an overview, and this is going to be a conceptual overview, partly because it's a podcast, but we're also going to provide a whole bunch of resources and follow-up material on our website. So make sure you guys, if you want more information, you can see that at www.infinitewealthcourse.com/IUL, right? We'll have all the resources there listed for you. But then also, if you have any questions at all, in our show notes, there's going to be a link to a 15-minute meeting with myself or Anthony.
Perfect.
Awesome. So Anthony, let's get started. Can you tell us a little bit about kind of the history of insurance here?
Right. Yeah. Before we start talking about what's going on today, we need to look back a little bit and talk about a little bit of the history. You know, there's first signs of insurance, Cameron, goes down to 600 BC. When some monks had combined some funds to prepare for the death of one of their members. Now, the first life insurance company can be dated back to 1750. Back then, the only thing available was whole life. I mean, where there's a fixed premium, and there's a guaranteed death benefit, and there's also equity that you have access to. And so this has been going on for over 200 years. And then what started happening, particularly in the 70s, interest rates became super high, right? So you could get a CD for like 12%. And then when people are looking places to store money, they're looking at whole life insurance, and it can't even compete with the CD. So what the industry did is they created called universal life. It's similar but very different. Instead of having a guaranteed portion, it's basically like a one-year term insurance, and then there is a side fund. And in the first ULs, those side funds were tied to some sort of interest rate. So which was great when interest rates were that high. And Karen, do you know who? And I know you know the answer. But who was one of the people who created ULs?
Who created it?
Yeah. E.F. Hutton.
Well, yeah, that was the company that promoted those.
Yeah. They were a big proponent of what was E.F. Hutton. And I remember those commercials as a kid because their slogan was, when E.F. Hutton speaks, everybody listens. But here's a question. When was the last time you heard E.F. Hutton speak?
Ooh, it's been a long time.
Exactly. Those ULs did not perform as well because what had happened? Interest rates went back down, but then the stock market went up. So then what these experts try to do is say, how about let's still do a one-year term, and then that side fund, we're going to invest in the stock market. Sounded great?
Absolutely.
Right? Until the next crash. And then people lost money inside their policies. And then from that turned into what's very popular now is indexed universal life. What is, there's still a one-year term insurance in there, but instead of investing in the market, it's sold as there's a floor, so you cannot lose, quote unquote, but there's also a cap. So in theory, there's a floor, so when the market goes down, you're not going to lose money. But in return, when the market goes up, you may not be able to participate in all of those profits. Which to be honest, it actually sounds good. And it sounded so good that I actually had a VUL probably 15 years ago. The way that my typical financial planner sold it to me was, Anthony, you know how you want to build some tax-free income. And the only thing we have is a Roth. The problem with the Roth is you can only put in $5,000, but also if your income was over a certain amount, you couldn't even put in the $5,000. So it was sold to me as this is a rich man's Roth. Again, sounded great. I looked at the illustration. Man, I can get tax-free income and I can invest in the market. Cost of insurance for me when I'm in my 30s, super cheap. I'm in. Got one for me, my wife, and both kids. And then 2008 happened. Then I actually learned what a VUL is. It's not a rich man's Roth. It's a high-priced product. And there's that ability for loss. So then when I realized that, part of what we're going to share today, I actually got out as quickly as I could. So that's kind of a summary of the different types of policies. But what we're going to talk about today is 5 reasons why we do not recommend an IUL to use the infinite banking concept. And Cameron, how hard was it to whittle down to 5?
Oh, it was difficult. You talked about prep, and we were prepping right up until we stepped into the podcast room, just because of the amount of information that is available that's out there, and just trying to consolidate that and kind of put it into kind of a coherent argument is, to be honest, is difficult.
Yeah, and there are so many reasons and so many pitfalls that are in this product that we want to make sure our listeners are aware of. We're going to try to keep today's podcast kind of a big picture and not get into too much details, but that's why we have that additional resources at infinitewealthcourse.com/IUL. There, we're going to get into the weeds and show you the numbers. And you want to know what's also going to be in there?
I'm going to guess a spreadsheet.
That's a good idea. There's going to be plenty of calculators, but there's going to be a link to a warning from the state of New York about the hazards of having IULs. So the first reason why we don't recommend IULs is a very fundamental one. If you've heard our podcast or heard us talk about our value as far as building wealth, we have what's called the hierarchy of wealth. And in that is similar to Maslow's human hierarchy of needs, that we need to start with the basic needs first before we build up to our other needs. Same thing with wealth. We need to first have a layer of assets that is certain, that we have collateral and control of. And that's what we're using our whole life for. And then we build on to assets that we have control of. And then we look at assets that we have collateral on. Once we've maxed out those top 3 tiers, then, and really only then, do we recommend you going into tier 4, which are speculative. Speculative means no certainty, no control, and no collateral. So when we're putting money into these policies, we want certainty first. But the problem is the IULs have actually flipped this upside down, and there is no certainty, collateral, or control. And here's one thing that's very interesting. Cameron, do you know that there is a superhero who has his own concerns about IULs?
I have no idea. Who would that be?
It's Batman.
Christian Bale?
Yeah.
Or Michael Keaton. I don't know which one.
Michael Keaton would have been totally different.
Yeah.
Well, I don't know. Maybe I sounded more like the other one, but I was trying to be like Christian Bale. If you remember, he was in the movie. Was he good? Okay, yeah. Thanks. He was in the movie The Big Short, which was actually a great movie that was about the latest financial crisis, particularly these mortgage-backed securities. He was one of the, if you remember in the movie, he was that centric guy who was like very, very brilliant, but a little bit out there. He was the one who first noticed it. He just said, these numbers are just not making sense. All this money is coming into these mortgage-backed securities, but the quality and the actual supply is not substantiating the demand. And well, the link to this article is going to be in the additional resources. And in essence, what he's saying, one of the problems with these index funds is that they're buying assets not based on the value and the projections of the stock. They're buying these stocks because they have to, because they're part of the S&P 500. So all of that money coming in has to be spread out to the S&P 500 stocks. Now, Cameron, do you know all the stocks of the S&P 500?
No, I do not.
Either do I. I actually looked through all 500 of them. I will tell you, I think 2/3 of companies I have never heard of. And of course, there was some Apple and Google, but you want to know what's also in there? Best Buy is in there.
Okay.
Macy's is in there. CBS is in there, as well as a couple cable companies. Now, if you're going to buy an investment, we should be investing in companies that have a solid future, that are going to make money in the future. But what's happening to retail and department stores in general? What's happening particularly to Best Buy and these electronic stores? Or people aren't watching CBS anymore. They're watching YouTube. They are streaming. So what's happening is these companies or these stocks are artificially inflated, because people are buying them not because there's value in them, but because they're part of the S&P 500. And what he says, that there is going to be a reverse. Instead of all of that money coming in, some of that money is going to come out, and that's going to be detrimental to those index funds.
That's really good information.
Okay, thanks.
Yeah, well done. So
more to come.
Yeah, I'm going to jump in here, and I'm going to talk about some of the reasons that some of the ways in which companies, the insurance companies that are selling IULs, will actually transfer the risk over onto the client. And inside this point, I've got maybe 3 or 4 bullet points that fall under here. So the first one that I'm going to talk about, Anthony already touched on this, but it's the cost of insurance. When you look at how an IUL product is created, Anthony mentioned, he just described that accumulation side of it, but we've also got the insurance side. And the insurance side on a UL product is built on a guaranteed renewable term policy. And so what that means is that if we buy this policy, if you looked at the costs on this policy when you're 25, 30 years old, they're going to be minimal, right? It's going to be really cheap and it's going to look really good. But if we come back and we look at it when we're 45, Anthony, is it going to be more expensive or similar or less?
It's going to be more.
And how about if we come back and we look at it when we're 55, 60?
Wow, even more.
Right? What if we go to an insurance company and we're 65 years old and we ask them for a 1-year term policy for $1 million? Is that going to be cheap or expensive?
It's going to be expensive.
It's going to be very expensive. And essentially that's what is happening inside of this product, is that guaranteed renewable term policy starts very low and then it just ratchets up every single year. It's just that stair step. It increases every single year regardless of what else is happening. And so what I did in kind of preparation for this is I just went out and I pulled up a couple of clients' policies of IULs that they used to have. And I found 2 things. One of them is the first piece that I have here is it didn't even have the guaranteed cost of insurance values in there. Actually, the note that it says is, if you'd like to get details of the dollar amount of each charge, please ask your advisor. Well, it's not even included in the illustration. We had to actually reach out to the insurance company and get it.
Hey, Cameron, how many of those advisors do you think have access to those answers?
I think they have access to it, but I don't think that they actually ever reach out.
Yeah.
Right? And the other one that I had here, this is definitely going up on the website here. This is a schedule of the guaranteed cost of insurance rates. And so what this shows us is that when this gentleman in his 40s purchased this policy, this is a breakdown of the monthly and the annual expenses on the insurance piece of it. And so what I want to go through is just list off some of these numbers at different ages. And the trend that I want you to see is that guaranteed increase year over year. So if we start with this individual's in his 40s, it is $180 a month is the cost of insurance.
Okay.
Seems reasonable, right? If you add that up, it's $2,160 a year. If we fast forward in his 50s, what we've got is we've got a monthly increase of a monthly premium of $395. Annually, that's $4,700, right? So if we fast forward another 20 years, right, another 10 and 10, is now we're in our 60s, and on a monthly basis, that cost of insurance has increased to $1,040, and that's $12,480 annually.
So now they're paying monthly almost what they were paying annually.
Yep. We started at 180 in the 40s. Now we're in our 60s, and we're paying $1,000 a month. We fast forward another 10 years, and now we're paying $2,800 a month and $34,000 a year for the cost of insurance. I can keep on going. We fast forward another 10 years. It's $88,000, $8,150 a month for the cost of insurance, or $97,000 annually. And if you keep on going, it's another $17,000 a month, $200,000 annually, right? I go through these numbers kind of painstakingly, and this is usually when somebody comes to us and they have one of these policies and they're kind of asking us if they can use it for banking or what they have or what the intent of it is, man, this is the first page that I go to. I'll pull this out, and if I don't have it, I'll have them request it, but we'll go through and I'll just start adding these things up, and I'll say, were you aware of this? I have not had a single client come in and say, hey, I understood that this is the way that this policy was structured. This is what it was going to do. So risk is put back on the client, right? The insurance company has laid out our costs for us, but all we have to do is go back and read the contract. All right. So does that make sense, Anthony?
Yeah. Yeah.
Awesome. All right. So cost of insurance is not in our favor, right? That's in the insurance company's favor. Let's move on to policy values. Well, actually, let me back up. I'm sorry. I should talk about the cost of insurance in whole life as well.
Sure.
Right? Anthony, you know this answer. Is the cost of insurance in whole life, is that an increasing cost, or is that a flat cost, or what is that?
It's fixed.
It's fixed, right?
Mm-hmm.
And so that's one of the big differences between whole life insurance and universal life insurance is whole life has a fixed cost. We know what it is from the get-go. As far as universal life is that it stair steps. It has that increasing balance. So, and what they're playing in this policy, the game that they're playing is that the market returns or the index returns that they're mirroring are going to outpace that cost of insurance. And so if we look at kind of that market side and the policy values in which they talk about accumulation, is when you go through and you read the fine print, what you'll notice is that IULs, the earnings are illustrated as a percentage, right? So those are usually gross percentages. And typically you'll see maybe 3% that's in there, and you'll have a minus, which is the mortality expenses, and then you got a minus the administration expenses. So if there is an increase in that type of account, there is an opportunity for there to be a loss overall in that policy.
Well, I thought that they say, well, that you can't lose money.
That's exactly right. That's one of the selling points. And so what they'll say is they'll say, you can't lose money. We've got a gross earnings rate, or we've got a floor of 3%. But one of the things that I think you mentioned this before is when we have these mortality expenses and the administration expenses, is those are both flexible, right? Which means that the insurance company can come back at any time and they can raise or lower those expenses. In all likelihood, that's going to be raising those expenses, right? And so there there are scenarios in which we could have that guaranteed 3%, but those administration, those mortality expenses are greater than that return. And so there could be a negative inside that policy.
So what happens when there's a negative inside a life insurance policy?
Well, what's going to happen is they are going to take that differential from the cash value of that policy.
Okay.
Right? Or you'll get a notice. If there's not enough cash value, you'll get a notice from the insurance company. I've got a story that I'm going to share a little bit later in regards to that. But if we compare that with whole life insurance, this is This is one of the things that provides certainty to me, as I own a whole bunch of these policies, is if you go through and you look at how accumulation is stated inside a whole life insurance policy, it's stated in a dollar amount. It's not a percentage. So when I look at my policies and I look at the guaranteed values at age 55, 60, 65, it's very clear. It is stated as a dollar amount. And so I've done this before. It's been years ago, but I've gone back through and I've actually added up all the guaranteed increases in my policies to see exactly what it would be at age 60, 65, and so forth. But real big difference, right? And so the kind of takeaway with policy values is that words are important, right? While interest rates are guaranteed, the cash value is not, right? So we've got to read the fine print when we're reading these contracts. So let's move on. We're going to talk about fees now, right? Fees is another point where, man, this stuff is really just thrown back over to the client. If you read these contracts, I mean, you can't get a paragraph or two without having the word fee stated in there.
Yeah.
And so what I did is, again, I just pulled out a client's contract, right? An old IUL that they had, and I started reading them. And I started making a list of some of the fees that are listed on here. And here's 6 or 7 of them that are stated. Number one is the percent of premium expense charge. There is a monthly cost of insurance charge. There's a monthly expense charge. There's a monthly policy fee. There's a monthly percent of accumulated value charge fee. And there are rider charges fees, right? I mean, it is just...
That sounds like a lot of fees.
It does. It sounds like a ton of fees. And what's funny is that, not funny, right? It's kind of sad, is if you read these contracts, when there's a huge paragraph, I won't read the paragraph here today, but essentially it just lists all the fees. And it says actual results may be more or less favorable. And that says see prior pages for guaranteed values. If you look at this contract and you jump to the next page where it talks about the guaranteed values, it shows a guaranteed lapse of this policy.
A guaranteed lapse.
A guaranteed lapse. So that means that this is guaranteed to lapse at, in this instance, I don't have the page in front of me, but I think it was at 55 or 57, something like that, pretty early on in the life of this policy. So again, the point there is that the fees are buried in this policy, and they're never typically discussed. What you've got to do is, you've got to go in there and you've got to read through the contract, and they're outlined in there, but they are difficult to find. But yeah, fees will get you. And we haven't even talked about the biggest fee, right? One of the biggest deterrents of why we don't like these contracts when we're used for banking. We're going to come back to that here in a minute, okay?
Okay.
What else we got? Mortality expenses, right? Another example of reasons why we don't like using these things for banking would be the mortality expenses. IULs illustrate the minimum mortality charges based upon current costs. So if mortality charges increase, the company will draw the difference from the client's cash value to make up the difference. So we kind of already talked about that. What happens a lot of times is that gets dismissed by advisors that are promoting these types of products. And what I mean by dismissed is the words that they almost always use is, this is not likely to happen, right? And so when you go back through there, is you read these contracts, and it does not put the client in a very good position. And what I mean by that is, man, I've got several stories that kind of illustrate this, but the one that jumps out to me was, I won't use her correct name, but I'm going to go with Karen, right? Her name was Karen, and she was referred to me. She came in and she had a contract. It was a UL policy. And she came in, she said, Cameron, I got this notice. I don't know what it means. Can you help explain it to me? And so I was like, yeah, let me take a look at it. So I had her come back a couple days later. I read it. I asked for some in-force illustrations. I had her request them. I looked at it. And essentially what had happened is she had this policy for several years. I want to say it was 15, 16 years, something like that. And at one point, she had almost $200,000 of cash value in the policy.
Nice.
Right? Exactly. And so she was under the impression that's what she had. The notice that she had received was that her premium had gone from not $5,000, but it had increased up to $25,000.
Wait, from 5,000 to 25. And how old is she at this point?
Oh, she's probably mid-60s at that point.
Oof.
Yeah. And the reason that she had got the notice was because internally in her policy, the cash value had already all been used to pay the premiums on this policy. Yeah. And so I, unfortunately, was advisor that had to sit there and let her know that this was her options that was available to her. Essentially, she had no cash value, right? So her nest egg was gone. And if she wanted to keep the death benefit in place, she needed to send the insurance company $25,000.
So what did she do?
She cried.
Yeah.
Yeah. Right. It was a tough scenario. It was terrible. I'm laughing, but that's just kind of how I deal with problems, right? But it was a tough scenario. She ended up walking away from the policy. There's no way that she was in a position to afford that. And that was really my first dealings that I had with UL policies, and going through and kind of sifting through and reading exactly what some of these contracts state and why she ended up in that position. So it was probably the worst meeting that I've ever had in my career. Yeah. Whole life, to kind of compare that is, right, the mortality expenses, they increase, they ratchet up, they're flexible based upon the insurance company. If you compare that with whole life insurance, when you illustrate a whole life policy, they illustrate maximum mortality expenses. So the only thing that can happen is they will decrease those costs on that policy. And if that were to happen, then the differential would be awarded or credited to the guaranteed cash value. So on the mortality side, mortality expenses on whole life is they can only get better, right? So what they're illustrating is kind of worst case scenario on the guaranteed side, which is that dollar amount increase. On the UL side, which they guarantee when they illustrate on the worst case scenario, it's always a lapse, unfortunately. Anthony, do you want to jump in there?
So kind of what I'm hearing, Cameron, is that if the insurance company doesn't do a thorough job as they expect in managing their expenses, that bill is passed on to the policyholder.
Absolutely.
Right?
Yeah.
And just as you said, and how many times, Cameron, I mean, so you've met with some clients and they had a UL policy, and that they had to let it lapse because the policy premiums, like in that example, went up 5 times higher. The same thing has happened to me as well. But Cameron, how many times have somebody came into you with a whole life policy and said, you know, my premiums have skyrocketed, and if I don't make these premiums, my policy is going to lapse?
Never.
Right? These products are very different, and there's a lot more flexibility. And in one of the pieces that's in our additional resources is a great detailed piece by Prosperity Economics. And that is a nonprofit organization that is designed to help spread the word about the truth in economics, particularly to financial advisors. And in there, they go very detailed of the differences. And one key difference is on an IUL policy, you have to pay the premiums. Those premiums have to be paid. In a whole life policy, they don't have to be paid. There's an option called a reduce paid up. And what that'll do is no more premiums are due, and they're going to make an adjustment to the death benefit. However, the cash value stays the same and continues to grow. So so if and when that were to happen in IUL, you're going to be like Karen. In the policy, you're going to have to pay up or get out. But with whole life, there's going to be some different options here. And the next reason, or the third reason why we don't recommend IULs, I just really did that pause and cough for dramatic effect, right?
Very dramatic.
So what is number 3? Number 3, and Cameron alluded to it, the policy can go bankrupt. So I like to say bankrupt. I mean, the technical word is lapse, but who really knows what lapse means? I mean, lapse, when I think it thinks that you and me jogging and I'm lapsing you about, about every 4th turn. No, but a lapse means a policy is no longer in force. That means that the the cash value is negative, and if you don't pay up, the policy is going to go bankrupt. But there's some important pieces in there. That means all of that money that you had put in there is gone. Your death benefit is gone. And I know a lot of our clients are younger, and death benefit really is not a priority. But it's not a priority when you're in your 30s and 40s. But when you're in your 70s and 80s, you really start thinking about your legacy and you would like to leave something financially for the kids. But that's gone. But here can be the kicker. All right. If you had taken some money out, like if you're using it for income, which is typically what a lot of IULs are designed to be for, if it lapses, we no longer have the tax-free protection of life insurance. Thus, if there's any gain in that policy, not only is your death benefit go bye-bye, you're going to get a 1099. So imagine getting a 1099 for 100 or 200 grand when you're 80 years old.
Yeah, no thanks.
Right? I mean, so the bottom line, there's just too many risks. And here's an analogy that I like to use.
Oh.
Let's say that you wanted to fly from California to New York. Okay?
Jet setter, huh?
Yeah. You're looking at it, and there's a few airlines, but one of them is WLA, Whole Life Airlines. Okay, these guys have been around for over 200 years. They have perfected the flight. They're doing it all the time. That is all they do. And they say, Cameron, we're going to guarantee you that you are going to arrive we're going to guarantee you're going to arrive in 7 hours.
Okay. And
then you might say, well, 7 hours seems like a long time. Well, as they said, this is a guarantee. We've had every flight that's left from California to New York has gone there in 7 hours or less. Every flight, meaning we have never had a crash. Right? And that 7 hours, that is assuming worst case scenario. That's assuming we're stuck on the tarmac and we can't leave LAX for an hour. That's assuming the entire way over we are going into a headwind. However, based on today's current weather environment, we can get you there in 5 hours. But we guarantee you we can get you there in 7, and we've never had a plane crash. Or there is ULA, Universal Life Airlines. These guys, oh man, these guys are the new hipsters.
Yeah.
Right? And I know, Cameron, you're a big fan of hipsters. Well, they're saying, that's 5 hours. We can get you there in 4 hours. What we've done is we've taken the same planes that Whole Life Airlines use, and we stripped out their engines. We put these brand new engines that are using the latest technology, right? And what we can do is when there is a headwind, this engine allows us where we don't have to take all of the impact of a headwind. In fact, this thing will adjust so there is no headwind. We're never going to go backwards. And part of that limit is when we have that tailwind, we may not be able to go as fast, but we're always going to be moving forward, never backwards. And we'll get you in there in about 4 hours. Sounds good, right? You would take them, especially if they're full of hipsters. But when you go to sign and check out, there is a disclaimer saying, based on the best conditions, the best conditions ever, we're going to get you there in 4. But if it's not the best conditions, we're probably going to get you. We're probably going to get you there.
What do you mean probably?
What I mean probably is, with this new technology, we've had a couple of plane crashes.
Ooh.
So maybe 1 out of 100 flights just are not going to make it there, right? But 90 of them are going to be there in 4 hours. So just don't be on the one that's going to crash. Right?
Yeah, that's easy.
What airline, Cameron, would you trust your family on?
I am flying first class in WLA.
Right. And that's what we need to look at it, these IULs sound great, right? There is no floor. So if the stock market goes down or if there is a headwind, no worries. You're going to continue to go. But there's a lot more nuances into it. But here's the bottom line. They may get you there in 4 hours, but they may not. And why take on the risk?
Well said.
Thanks.
Well said. Another reason that I'm going to jump in here with why we don't recommend ULs for banking would be the reason that it's called surrender fees. I know I touched on fees just a minute ago, but this is probably the biggest one for me when you look at this is, again, I pull out clients' contracts and I'm looking at this thing and, man, I pulled out two different ones and one of them had surrender fees all the way out to year 15.
Yikes.
The other one had surrender fees all the way out to 10 years. So just briefly, let me try to describe to you guys what a surrender fee is. In this example that I was looking at, is this client had a guaranteed cash value of $40,000. That means that's the cash value that he has in the policy. He has a surrender value of $22,000. So that means that if he were to walk away, he would end up walking away with not the 40, but the 22.
Mm.
So his surrender fee was $18,000. Unfortunately, the numbers that I'm giving you are of an actual client that I've had. As this gentleman was sent to me, again, it was referred to me. He's out of Florida. He called me up and he said, hey, can you look at this, at what I've got? And the policies that he got from a very nationally well-known company that told him that they were banking policies.
Mm.
And we looked at them, and unfortunately, they were universal life policies. And unfortunately, he not only had one on himself, he had one on his wife, and he had one on his two kids.
I know the feeling.
Yeah, and we started going through those and started adding up all these things, and the numbers that I just shared with you were his realistic numbers. Is we looked at this, and at the end of the day, he had a surrender fee. If he wanted to walk away from these policies, he was giving up $18,000 in surrender fees. And to my surprise, he did it, right? I mean, that would have taken a long time for me to kind of come to that conclusion. That's a lot of money. And we went through all of his options, kind of laid out what was available to him. He did choose to move forward with walking away from that. And I had him actually write a letter. The letter that I had him write was saying, I so-and-so knowingly and willingly am choosing to walk away and pay the surrender fee of $18,000 from these policies, because that's personally the most amount of money that I've had somebody walk away from these policies. But he came to that conclusion after looking at these and realizing that that surrender fee was inhibiting his ability to borrow against that cash value, right? And so what he wanted to do is he wanted to move that cash value, the cash that was available to him, the $22,000. We 1035 exchanged it over to a whole life policy, and then what he's able to do is he's able to use that cash and then move on to real estate and other things that he was doing. But that is probably the biggest reason why I'm not a big fan of these. Those surrender fees in the first several years are such a huge deterrent to allowing us to bank. It's I don't know, it's tough. It's tough because it hinders us, and then it's also just a big cost for us. So also another reason why we don't.
You know, Cameron,
go ahead.
Let me add a story in there, because honestly, I had a similar story, but with the opposite outcome, where I ran into a client where he had learned about IBC, so he had met with me, and he goes, you know what, I just got an IUL policy, and again, I thought I was going to be able to bank with it, but I can't, and so I analyzed it. And the problem was, just as Cameron said, because of those surrender charges, that hinders the access that you have to your cash value. So in his case, he really couldn't even bank or have access to cash value until a little bit in the fourth year, right? But really, it didn't really cash flow until year 5. But with him, he had a very hard time about the surrender fee, but also he had paid 1 year's premium, and he in essence had no cash value. And I talked to him and said, well, you know what, let's look at this in the long term. You know, some options were for you to stop funding that policy and start a normal whole life IBC design policy. You know, when we went out, I think by year 6, we had more cash value, including the taking the surrender fees out. But the problem is, doing the whole life, he was going to have more money at the end of the day, and he didn't believe in the IUL. But the obstacle he couldn't get over was he didn't want to realize that loss. I know I already paid a premium, and I know I'm never going to get it back. But he just did not have the heart to stop funding that policy. Which to me, one other thing that angers me about these IUL policies is that they're being sold, and then these people they have something that they thought they have something that they thought was different than what they actually have, and then that's a black mark on other advisors and other forms of life insurance.
I agree totally, and this is also an article, I think you mentioned it already, if not, but we're going to include a piece in there that there are class action lawsuits that are happening and have happened against these insurance companies because of the design of these policies. So we'll make sure we share those as well. One of the things, just generally speaking, that I'll add there is when I'm talking to somebody about ULs versus whole life is I describe a UL policy as a depreciating asset, right? And I'll describe whole life insurance as a guaranteed appreciating asset. And so if you know you have a depreciating asset, when is it of its most value? Now, today. And so let's get rid of it now, today, when it has its most value in it, and then kind of move forward. So just generally speaking, that's typically a comparison that I'll make. But what else? I think I was talking about Nelson, right? We're talking about kind of Nelson is another reason why we don't recommend ULs is simply because Nelson Nash says not to.
So what you're saying, the guy, the author and the creator of the infinite banking concept, who's been one of our best mentors and created this concept, says don't use this product for this concept.
Very blatantly, he says that.
Okay. I mean, you're the man, Nelson. I believe you. I mean, we could have just said that on the podcast.
Absolutely.
Bottom line, if you want to become your own banker and you're listening to our content and the content from Nelson Nash, he says don't do it. So you know what I say? Don't do it.
We could have made this a 5-minute podcast and people wouldn't have to listen to you for 45 minutes. But
ditto.
The reason that Nelson cites a couple different reasons on why we shouldn't be, and he talks about the history, right? We already talked about the history, but he looks at the history and says, listen, universal life products came out in the late 70s, early 80s. So what does that make them? 40 years old, maybe 50 years old at best, right?
Dude, FY, somebody born in the 70s is not yet 50 yet. So, okay.
So they're old, right? When you compare that with whole life insurance policy, man, these things, right? They've been around forever, 200 plus years. The insurance companies that we're looking at, these, they're 150 years plus of paying dividends and just a phenomenal track record. So, I mean, those don't even compare. And then also what he talks about is the same things that we talked about is just simply the design of separating that cost of that term of that insurance, putting it into a term product, and then trying to outperform it in a market which has all sorts of variables in the market, and that term insurance, right, can go up, go down. Mortality expenses are at the complete control of the insurance company as well as the administration expenses. So like you said, is at the end of the day, essentially what Nelson is saying in that book is we're advisors. What we need to do is we need to do what's best for the client. And what's best for the client, in our opinion, is not using universal life policies. one thing that, right, if somebody actually reads Nelson's book and gets through it and really has a basic understanding of what Nelson is trying to tell us, is Nelson is showing us that the insurance policy is more or less a cash management tool.
Yep.
Right? Is he is saying, listen, we are going to take our cash that's available to us and we are going to protect it, right? We're going to protect it from inflation. We're going to protect it from taxation. We're going to protect it from lawsuits. We're going to put it over here into this policy. And now when opportunities present themselves, we're going to tap into it and we're going to go and use that cash value or take loans against that cash value to act on those opportunities. And so if someone really understands kind of the basic message that Nelson's trying to portray in that book is IULs are off the table, right? ULs are off the table. It's not, shouldn't even be a consideration. So I work with a lot of business owner clients. I know you work with a lot of business owner clients. And man, business owners, they have so much risk and uncertainty in their business, regardless if they've been successful for 20, 30 years, right? Next year is we start over every single year on January 1st, and you just don't know what it's going to bring. And so we work really hard for our money. Business owners in general work really hard for our money. And so when we do create a profit and we want to put money into savings, we have got to make sure that we can put it into an account where it's going to be safe and it's going to be there for us when we absolutely need it. And there is no better account than a properly structured whole life insurance policy. Why are you smiling?
No, I'm just smiling because I agree with everything you're saying, and you're kind of I can tell that you're passionate about this.
Yeah. Oh yeah.
So you're going out of the outline and just saying, boom, boom, boom. I mean, I totally agree with you. I just like enjoying. You're just kind of going off the cuff, and I like it.
Yeah. That's not in my notes, and that's as passionate as I get. That's all the emotion that you guys get from me, right? But yeah, I mean that's it for that piece of it. Anthony, do you want to just kind of touch on the next point?
Yeah, what I would say, all of the other reasons that we've had are more like logical reasons on why, but if you just listen to one reason, right, and this is my bottom line version of a IUL, is that in addition to that amazing story that I shared, is that an IUL, to be honest, and there's two columns on there's multiple columns on the IUL illustration. One on the right is like best case scenario, and one on the left is worst case scenario. You know what? Nobody knows what's going to happen. We're not saying that best case scenario cannot happen. I mean, I don't believe it will, but it's possible. It's possible that it will, but it's possible the worst case will happen as well. And what I say, to be honest, in all practicality, I don't think the worst case scenario is going to happen, but I don't think the best case scenario is going to happen. It's going to be somewhere in the middle. And my point is, why take on that risk? If you want to invest in the market, invest in the market. Buy term insurance on the side and invest in the market. Your life insurance policy should not be a high risk asset. And in addition, to me, it all boils down to this: what are your goals? And that's why when we meet with clients, that's one of the first things we talk about is, what are your goals? Because there's no value in working with us if we can't help you achieve your goals in less time with less risk. And so also, we want those goals. We want you to know your goals. So when you're in between making a financial decision, go back to your goals and see, well, which one of these decisions is going to help me achieve my goals? And with most of the people that we meet, their goal is not to have a high net worth or assets. What they're focused on is building some passive income, building some income now. And so if that's your goal, which one of these is going to help you achieve them faster? There's too many obstacles with an IUL to help you get there. If you want to create passive income, just as Cameron said, a whole life policy IBC is not an investment strategy. It's a cash management strategy. And that's going to allow you to invest in your business, invest in yourself, invest in real estate. And making those investments are going to reap larger rewards than any mutual fund, any stock, and of course, any IUL.
Well said. Speaking
Thanks.
of going off the cuff. Yeah. Anything else you want to throw in there?
No, well, like for one example, we have a lot of clients that are investing in real estate.
Yeah.
And a lot of them are flipping real estate. With the way we design these policies for IBC, we have clients that are funding it, honestly, on the first of the month and pulling out a max loan on the 31st. And they're using that to flip real estate. So that's what we're using. This IBC and these whole life policies are just a strategy to help you achieve your goals if they are creating passive income, reaching financial freedom. Passive income is more than your expenses.
Last piece that I'll throw in here is, it's my belief that every UL policy should have a big red stamp that's on the front of it that says buyer beware. Right? And the reason I say that is I've had some very, very educated, much smarter than myself clients come to me with these types of policies. With these types of policies, and literally all I did was read the contract back to them. If you have this contract and you need somebody to read it to you, schedule a 15-minute phone call with Anthony. He's okay at reading. Right? No, it's just right. But pull up the contract, start reading it, and very quickly you'll kind of see the reasons why we're not big fans of these policies. And if you guys need help kind of sifting through these, I'm being dead serious. Schedule a 15-minute phone call with us. We'd be happy to help you out with these things and lay out your options for you. But
I think a lot of people just want to know what they have. And when we look at evaluate these IUL policies, there are a lot of options. Sometimes there's some tweaks that we can do to that policy for you to keep it. Right? Maybe you should roll it over similar, kind of like an IRA, where you roll it over into whole life. But that is not the answer for everybody. It's going to determine on the policy and your health. And again, more importantly, your goals. Which analysis is going to help you achieve your goals faster?
Yep. There are strategies, there are scenarios in which I've recommended a client keep an IUL, keep a UL policy. And we've done certain things on there to preserve that as long as we possibly can. But like I said, a whole bunch of options that we can discuss with that. But again, we're going to wrap this thing up, and make sure you check out our page, www.infinitewealthcourse.com/IUL. We've got a whole bunch of resources. Anthony, you've got some of those resources there. Do you want to read them off?
In there, what we're going to do is we're going to go through an analysis of an actual IUL illustration, and then we're going to compare it to a whole life illustration. We like to say here at Infinite Wealth that we do the math, and we're going to do the math on the validity of the rates of return on these IUL policies. Specifically, their market goes up and the market goes down. These IULs are sold where there's a floor, right? So you can't lose money, quote unquote, but there's also a cap on how much you can make. So what we're going to do is we're going to pull up the last 30 years. Okay, this is what it was with no floor and no cap. And then with the so-called benefit of IULs, here is the impact with a floor and with a cap. And I will tell you, you will be surprised of the difference of the numbers. Also, Cameron's going to do a video, dive a little bit deeper on the illustration that he had shared with those increasing expenses. In addition, there will be links for some white papers, as I'd mentioned, the very detailed one on prosperity economics. There is the link for the article from Batman. Okay. I totally need to work on that, and I may go back and edit that out.
Was that a whisper?
And I'm just going to make it worse. But it's a good article. Right, and we're also sending you the link to the to the warning that the state of New York had on the IULs.
Awesome, a lot of really good information in there.
Yes.
Perfect. Let's wrap it up.
Okay, awesome. Thanks for listening, and go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.